You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup Larsen, are back with this week's edition of the Systematic Investor Series, where we share our experiences, the ups and the downs of what it's like to be a rules-based investor. And of course, where we also take your questions. And as usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Hello, gents. How are you?
Good morning. Good afternoon.
Very well, thanks. Very well. So a week which I think was mainly about the bonds and fixed income markets in general, at least when I look at kind of our P&L that stood out. But we did see some decent moves in gasoline and nat gas and palladium on the upside, and wheat, sugar, and silver were kind of the leaders to the downside this week, at least in the markets that I keep an eye on. So why don't we jump into it, Moritz, and see how it all played out for you this week?
Yeah, it played out just like you said. Summing it up, it's been another bad week, really. Quite bad, minus 3%, roughly. And so the bonds that didn't work got quite a few signals, actually. Got shorter in Aussie dollars and Canadian dollars and euros and yen versus the US dollar. A little bit less short in the equities. So, for instance, the CAC changed from short to long, as did the FTSE and the SPYs in Australia. And some, changes which, looked at it was, oh, that's interesting. So, it used to be long gold and long silver, and those are now slight shorts. WTI, generally the energy markets, still a bit short, but getting longer and longer there. That was the week. But I'm just, craving for a turnaround now.
Yeah, no, absolutely. I think we probably all are to some extent. I certainly saw the same. For us, also a bit of a down week. Not too bad though, but still, the fixed income markets were the main culprit this week. And what we did see some positives, in particular in the grains. Grains did well for us. Energy did okay. But the single best market for the week was the yen. So we did all right on that side, but we couldn't quite overcome the negatives coming from the rising yields in the fixed income markets. Theme-wise, exposure-wise, I think the only change we've seen recently is this kind of gradual move from being short equities across the board. Now we're kind of slightly positive on an aggregate basis, but with mixed positions. But there's certainly been a recovery in equity markets, which are being reflected as they should be in the way the models are picking those trends up. So that's, I think, is the only sort of change in terms of theme on our side. What about you, Jerry? I mean, single stocks are always interesting, but it could be some other markets that has had an impact this week.
Sure. We continue to add a little bit all the time to our long single stocks and reducing slightly some of the shorts. It's so much fun to see the stock market in those terms and not the indexes. And so it's always trimming and adding. And unlike the currencies where we're pretty much 100% short, I was able to hold on to about half my yen short through the big rally. But in the stocks, it's lots of longs, lots of shorts, lots of flats. So it's much more diversification than I'm getting from some of the other interest rates and currencies. Very fun to watch the grain, wheats and canola kind of crash. That short, trying to be patient with those. And, I like to see that. We're holding in there in the dollar, but I'd like to see some crashes like that, like I saw in canola and wheat. That'd be funner.
Yeah.
Nice to see that silver and gold turn around. Sorry about that. I never quite got long. I did get run out of my shorts at the high, so I don't know what that means, but still enjoying platinum and cattle. And emissions. I don't know if you guys trade the European emissions, but we do, and those three are just the best longs that I have.
Do trade the emissions. They have been volatile the past couple of weeks. I mean, they had those very, very nice trend to the upside, I think, until last year in October, and then, plateaued a little bit, just, became range bound, but very volatile market. Also still long that market. I think in the last week it moved up a bit, so that was good.
Yeah, and we don't participate in those markets, so but it's clearly definitely a differentiator when you look at performance among seemingly similar trend followers. That, I mean, you get a lot of return dispersion from the fact that we obviously don't all trade the same market. So definitely worth keeping an eye on, especially for those investors who are sort of doing their due diligence on managers, where the returns actually coming from. Now, there are lots of questions. We want to get to Jerry's top tweets since we didn't do so many last week with MEP, but what a great interview with him, even if I say so myself. I mean, he just built so much value, I think, on last week's episode. So if you missed that one, I would encourage you to go back and listen to episode 24 with MEP Faber. But there are also some interesting articles that I'm sure we would want to comment on. So should we do Jerry's tweets first and then take articles and questions at the same time? Does that make sense?
Sure.
Great. Well, social media land, how did that pan out this week?
Way too many things to talk about this week. I'm going to have to cut it short. Very prolific. I copy paste, so there's a lot of good writing, according to me, out there this week that I enjoyed, and not shying away from the things that I read that didn't make trend following. It doesn't make trend following look great. So we got lots going on, but we'll try to limit it to the most popular, at least. The first one is from Forbes magazine, and this got the most attention, I suppose. What makes greatness is failing fast, not losing too much, but repeatedly getting up to bat and making the solid swing. The way to build superior long-term returns is through preservation of capital and home runs. So, that is a typical tweet of mine that's going to get a lot of love, because it's, encouraging all of my 18,000 followers, who a lot of those are suffering like we are with trend following. So they love to be built up and given encouragement. And but I think the last sentence is pretty interesting in that, no one really wants a lot of strikeouts and then home runs. That's really not how we're built to enjoy life. And we've been getting a lot of strikeouts mostly recently, but I think that formula, has proven to be successful in trading and in lots of walks of life. And it is very frustrating, and yet that's maybe one of the reasons it works. But taking small profits is probably not something that we should aspire to.
No, I mean, there's no doubt that it's something that has proven its worth over many decades, but I agree with you. I mean, part of the reason, and I think that's, maybe something we also touched upon with MEP last week, was the fact that it's a difficult strategy to hold. Maybe it hasn't even been marketed very well, according to him, but it's a difficult strategy to hold. And I think that's definitely the secret to why it works. Anything that gets too popular seems to lose its grace. I mean, when you look back in history, there's going to be many periods of time where any strategy, for that matter, doesn't work. I mean, clearly we've all forgotten the 10 years of zero return in equities in the US. But if we go further and we expand, we look at other markets and other countries, I mean, their equity markets have had yielded no returns for much longer periods of time. But when it comes to trend following, people like to remind us that it's about time to make some kind of return. What about you, Moritz?
I like the analogy. That's what we do. Lots of strikeouts, and more rare home runs. I mean, if you think about a baseball game, how boring it would be to watch such a game where it's just, strikeouts, really nothing happening. People want the action, right? They want to see something and, stuff going on. That's just not the way we trade.
No.
It's funny you say that because that's exactly what's happening in baseball in America. The quants and analytics has gotten a hold of baseball, and last year, I think for the first time, there were more strikeouts than hits. So even the sort of idea has bled over into sports that launch angle and all of these newfangled ways of looking at baseball hitters. There's never been more strikeouts, never been more home runs. So it is boring, and nobody likes it in baseball. No one likes it in trading, investing, and so there you have it. It's the best thing, and it works, and no one likes it.
Yeah.
That's the reason why it works.
What else got some attention this week, Jerry?
Well, I'll pass on the Bloomberg article until we're
we'll take
all
that
ready
later.
to do that one. Let's see here. One I just tweeted like yesterday or so got a lot of attention. It's Meb Faber interviewing Marty from Dunn, and Marty describes that trend following is pretty basic, but there's magic in how you develop a portfolio with the strategy. And I really like that because I think that particular magic is underreported or underappreciated. That although I do put a great deal of importance on entries and exits and things like that, I think the way we set up our portfolios within how we try to, in my case, try to maximize the diversification with the right amount of single stocks and currencies, commodities, and interest rates is something I'm working on all the time to get a deeper understanding and knowledge, especially breaking away from the way I used to trade, where, like I said, in 1990, I made 30% in December, 30% for the year, and 30% in that heating oil trade in December. So that is not something you want to do. I mean, making 30% you do want to do, but not the way that I did it. So I've evolved into, hundreds of little positions, but still, like I said earlier, I'm not happy when I'm short all the currencies. I mean, is that right? And what percentage of my portfolio is currencies? It sounds like it shouldn't be that much, but it is. It is probably a little bit too much. So, and interest rates, I'm long all the bonds. I like the stocks. I'm long some, I'm short some, but I don't know how many am I short, and what are they going to do when the market crashes, when that diversification, which looks wonderful now, goes to kind of like 1. My longs will be down how many percent more, 2 or 3 times more than my shorts. So this puzzle and this magic that he talks about is very important for the CTAs.
Yeah, I mean, I think definitely Marty is right about that, and of course I would say that since I work for him. But other than that, I would say what you're addressing, Jerry, is quite important, and I wonder whether this is to do with the fact that in the old days, the economies of the world were not as coordinated as they are today. So maybe back in the 70s and the 80s, when you were looking at these different markets, the correlation between them were a lot lower than they are today. But clearly nowadays, and you're absolutely right, I mean, we often see situations where we end up being, fully long bonds across the board, or in the currencies we're either long or short the dollar and equities. But then I want to say, looking at last year, though, last year was a very different year. So even though we've had more coordination between economies and central banks, last year, certainly on our side, we had very diversified positions within equities and within fixed income. At very, few, a little of the time last year, we were fully long or fully short. I mean, for the most part, we were, in fixed income, we were short US and long Europe, and in equities, it was kind of the reverse. So So I mean, so even though they can seem incredibly correlated at times, and you're kind of wondering, is this right? There are still some times where it doesn't quite pan out like that.
That's right. I mean, 1987, silver doubled and gold went up a few bucks, and
yeah, sure,
more than once. It was twice. The first big turtle trade, Fab heating oil, 1984, it doubled. It went from 50 cents to $1 crude, and I don't think there was an unleaded contract at the time.
Right.
There may not have been a crude contract actually. So, but then there was another time, 1990, which I've already spoken about. It doubled, and then crude kind of sat there. So you're right. 90% of the time, silver, platinum, and gold have an 80-some% correlation at least. Same with crude, unleaded, and heating oil. And then they don't. So what are you going to do?
Very true. I mean, you can add, we've certainly looked at other markets to add that are less correlated within fixed income, within equities, et cetera. But yeah, I mean, on the other hand, I think we like to have maybe a smaller portfolio of markets compared with other managers who trade 200, 300 markets. We tend to be much more focused than that, but still get full sort of exposure to all the sectors. Any thoughts on this, Moritz, before we go on?
I like trading all of those. I think it makes sense to add markets to the portfolio. You know, speaking about that magic, which Marty was referring to, I like that. You know, I like looking at the portfolio with all its ingredients, all the markets, all the moving components. You know, things that go on. You know, thinking carefully about adding markets. Looking carefully about the correlations between markets, all of that. And yeah, I mean, just like you said, Niels, last year was a good example. I also remember being short the U.S. markets on the bond side, long most of the European bonds still, and the JGBs. Then it changed again. Then we went long the U.S. bonds, and like that, made money from that. It is just a byproduct of those markets that every once in a while those correlations that you've observed in the past, they don't hold, and you get a different set of positions in the portfolio, and that's important.
Yeah, I mean, I would just add to that before we move on, and then that is that clearly there's been a time after the financial crisis where a lot of the central banks were very, very coordinated, to some extent at least, in terms of their policies, right? But I think that's changing, right? We have very different situations now in the US, in Europe and Japan. And I think over time, this could lead to much more divergence in terms of central bank policy and therefore the market. So I wouldn't give up completely on on our portfolios as they are right now.
No, and neither do I. I just, when I look at you read all those articles in the media about the state of the markets and the economies and what, countries could be going into recession and which ones don't. I mean, I think there's always something going on. Even if economies are running swimmingly and everything is like blue skies, you will read in the media about, cloudy skies and, risks ahead and, this could go wrong and that could go wrong. Nobody of us knows that. We just are, all of us are unable to forecast the macro side of things, right? It's just not what we do. And then, right now, I feel that there's this massive concentration about, people speaking about risks coming from Brexit, coming from China being, maybe over-levered, having problems with the yuan. Then there's, countries going into recession. Maybe, Europe is starting that. Australia may be already in a recession. I mean, there's always something going on. We're just unable, I'm definitely unable to forecast anything on the macro side. I just have no idea what's going to happen. Definitely not, within the next couple of months. Anything can happen. So I need to stay as diversified as I can, as risk controlled as I can, given the environment. And sometimes it plays out that way, sometimes it plays out another way. But the systems that we have, they can cope with, and hopefully can cope with, whatever deck of cards we're dealt.
Sure, I agree.
There was so many tweets I read this week, and where people are just like talking their position, here are all the negatives about the stock market. People are totally worried. They should be worried and concerned. And I'm like, yeah, well, that's great. Cause I think, climbing that wall of worry is great. I think it's fantastic. And I don't know what it is about us, but I think, the trend follower mentality, I mean, definitely we kind of root for our positions, and I'm hoping that they're going to continue, but not in sort of an intellectual way where I am invested in some sort of other knowledge other than the trend, to where my sort of self-worth as a human is like, I've analyzed this. I've seen all of these issues that Moritz mentioned, plus a slowing economy and this number and that number, GDP, farm, payroll, whatever those things are. And then it's kind of like he wants feedback. He wants, okay, yeah, I agree with you, and somehow this is supposed to help. But it's just really interesting that people, and then the next tweet will be, no one can predict. Well, you just predicted. So I think our stress level is high based upon performance, but incredibly low when it comes to having to figure out what we should do next. We kind of know exactly what we should do next. Not that it's going to work, but we're not confused. And I think getting wrapped up in some of these fundamental viewpoints and really investing your self-worth into them, it's got to be very destabilizing.
I mean, I agree with that. And it's interesting you bring that up about, how people, may feel confused at this stage and so on and so forth. I mean, just go back 10 years during the financial crisis. That's when people were really confused and had absolutely no clue what to do, and where it, had big implications, what directions your investments were. So even after 10 years of sort of the world keeping it or holding it together, I think you're right. I think there are actually quite a high stress level among many investors, and it's a shame, because in many respects, I truly believe you can build both safer and better performing portfolios just by being sensible and logical about your overall asset allocation, and where you don't have to worry too much. I mean, let us do the hard work in terms of our strategy, and other people do the hard work when it comes to the nitty-gritty of their strategy. But from an investor point of view, I think there are really good opportunities today to build pretty robust portfolios overall.
Yeah. Also, one thing I just want to add that sometimes, and I enjoy, reading the media and, getting, a report on the state of the markets and what people think. And, I'm not a part of that opinion contest, but every once in a while they then interview managers and, discretionary managers, macro managers, say, and they're being asked, what was your the greatest failure? And then they go like, oh, well, in 2012, I called, ABC wrong. And it's kind of like, it's that chip on their shoulder there. It's a mark really bad. They got it wrong in this year. And it's kind of like they have to remember that and live with that. And I go, well, you know what? I'm failing all the time. Like, my specialty is failing. Like, I'm the master of failure. It's just, those things fail. The trades fail. A month fails. A quarter fails. Many subsequent trades fail. And so what?
But the key to all of that, Mort, is that trend following systems fail fast. And that's the key. I mean, when you listen to, if we go outside our world and you just listen to a lot of these really successful people in other businesses, and you often hear them on podcast or whatever interviews, and they ask about, what are some of the best advice that you can give, is really the importance of failing. I mean, there's no doubt it is important in what we do to fail, and fail well, and fail fast.
Exactly. Great failures.
Yeah. Good stuff. Jared, you have another one that received a lot of love?
Yes, and this is following up on what we just got finished talking about, and the first one with strikeouts and home runs. So going a little bit deeper on that idea, this was one that I came up with on my own, but I was inspired by another one. So it says, most of the time one can easily recover from a type 1 error, which is an unsuccessful attempt, a bad trade. We have a stop loss, but it's harder to recover from a type 2 error, which is not taking a trade, not doing something that might have had a positive outcome. because they can become incredibly positive outliers. So once again, nothing more important than doing the trade, do the entry. When I first started my first week of trading, Richard Dennis calls me up and he says, well, how many trades did you do this week? And I said, probably like 5. And he goes, well, how many do you think you should have done? I'm like, probably 20. He was like, yeah, that's like the first rule. Just do the trade. You're going to miss these outliers. So it's bad to get the strikeouts, but nothing is worse than having a systematic approach that you don't implement, or that you're kind of get timid, or one that filters you out, quote unquote, of a trade that ends up being a big, huge home run. So nothing more important than in another tweet also, I commented that you put a trade on only to have to take a loss. You can avoid that by not doing the trade, but if you don't do the trade, you're going to miss the big outliers. And then I wrote hashtag asymmetry. It's just not a good bet. Every time we look at a decision, we have this amazing backstop, the small loss. Yes, I'll do it. It's a small loss. Worst case, small loss. And I mean, that is just quite an advantage if you have that mentality.
Yeah. No, I mean, it's so true. And it's funny because and I don't know whether this is a good analogy or not, probably isn't. But anyways, humans often take those bets in their own, like they play the lotto, whatever, because it's just $10 we pay. But what if we win, $500 million or whatever it is in the US with these big payouts? I mean, there's, that's the thing. But anyways, Moritz, anything you want to add?
I like that particular tweet, and I think retweeted it. Everything there is correct.
But I would just say that I left off one interesting idea, which is that if we're talking about money, then everyone agrees, right? Oh, yeah, I agree. But it's not always about money. It's about, oh, crap, I was wrong. Yeah. That is a lot for me to handle. So once again, get into trend following. Maybe after a few years, it'll become the money, the betting and strategy versus your sort of self-esteem. 40% winning trades, our self-esteem cannot be too high as far as prediction goes. But I'd like to end, if we're going to end on this one, let's see if I can find it. Oh, yeah. Now, I really like this. And I always like to read about value investing and fundamental and traditional and non-trend technical trading from smart people who've made lots of money. And just to sort of understand and the differences. And once again, this comes from a very famous person, Charlie Munger, the second most famous American in investment. Okay, so he says, quote, "The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple," unquote. Wow, now, that's really amazing quote, because I really love that we're on opposite points of view on that. And I feel sorry for those guys who have to trade that way or manage money that way, because it probably does work for them. That, idea 10, a fundamental value idea, number 10, it probably may not work as well as number 1 or 2 or 3. So there really is a problem. I haven't done the analysis. I assume they have. And so they really do see a problem with diversifying. But I wrote, for systematic strategies, all markets and trades have the same expectation. They don't suffer from over-diversification like value, et cetera. So being able to craft a portfolio of longs and shorts in diverse markets that a systematic strategy allows, you don't have this issue of over-diversification. You can under-diversify by trading crude, heating oil, unleaded, the same size as cotton. I wouldn't really recommend that. But I've done it, but I don't think I was correct in doing it. And so one of the most profound things about trend following and systematic strategies, is the trades. They all have the same expectation.
That's certainly what our research shows. Which is why we treat all markets equal. I mean, whether it's, live cattle or the dollar yen, I mean, we treat them from a risk point of view equal. Now, clearly, there's going to be periods of time where one sector and maybe one market is not really adding value at all to the portfolio, and you're kind of thinking, well, maybe I'm wrong. But when we talk about we have the same return expectation for all markets, we're thinking 20, 30, 40 over that long period of time. But we completely agree with you, Jerry. Interesting stuff. Moritz, you want to add anything before we jump into some questions?
I think this, we say this and we believe this, the markets have, the trades have the same expectation, and that's absolutely true. I think, maybe I need to bring this up with investors. I think people have problems understanding that when we say, like, maybe not the listeners, but I think in general, if, you're the investment manager, you're speaking to a client and you tell them, we think our trades, everything we do has the same expectation, they will probably go like, what? I mean, you need to have preferences. You need to be able to say that you're now in an environment where, this works better than the other, or, one market works better than the other consistently. But we're not doing that. So I always have that in the back of my my head, that I want to get into a bit more, detailed conversation on that also with clients, because it is a strong underpinning of how we trade.
And I followed it up with another tweet that was so maybe diversification is, quote, the only free lunch in finance, unquote, which is reduce risk at no loss in returns, only when it's used with trend following. Sorry about that. But, if adding diversification to your portfolio, a value manager, if he sees reduction in return on his 8th, 9th, and 10th idea, bummer, come over to where we are, and there is no reduction in return, only reduction in risk.
Yeah, absolutely.
Yeah, agreed.
Okay, let's kick this off. I hope we can get through all the questions today. Otherwise, we will, of course, keep them for next week. And by the way, keep sending us your questions to info@toptradersunplugged.com. We love to be able to answer these. First question today is from Carl. Carl has a very short question. He asks, where would you start from an individual trader standpoint? So I'm not entirely sure what you mean, Carl, whether you're thinking about becoming a trend follower. So I think that's probably what we should assume. So I don't know if any of you want to kick it off in terms of where to start if you want to become a trend follower in today's world.
Well, to start, start with data. Find a good source of market data. That's important. There's a couple really good ones around which don't cost that much. And download that data. I recommend, starting with Excel. There's no need to become, heavy into programming. Keep it simple when you start. Develop a, simple, if I may say that, trend following system. Maybe work with moving averages or breakouts, and just get a feel for, how you need to build that, how that works when you add more and more markets together and how it behaves. I think when you do that, of course, there's, tons of things that you can read. The internet is full of good things on trend following. It is really, the concepts behind trend following are not a secret. They can be found. And then it's, it's a question of finding your own magic, your own system that works for you, where you feel comfortable, being able to follow it, to trade it, and hold on to it, which at the end of the day is the most important thing.
That's right. And then once you get into it, you're going to be able to hold on to it a lot easier if you trade moderate size and don't trade too large. Been there, done that. So, but yeah, I think Excel, one of the greatest inventions of all time, putting up charts, weekly charts possibly, and putting breakouts around some weekly charts to sort of get an indication of what are mega trends and what sort of time frame, look back period does one need to sort of hang around those mega trends? I think that's all good. Reading the Market Wizards books, listening to this podcast, all good stuff.
Of course. I agree with what Moritz and Jerry said, Carl. I would be a little bit skeptical with what you find on the internet. Of course, I think there's a lot of there's a lot of good stuff, but there's also a lot of bad stuff. So just be a little bit critical about that. Try a few different types of trend following models. Breakout for sure. Maybe moving averages. Maybe combine them. See what it looks like. Completely agree with Jerry in terms of trading small. I think that's super important. But then I would also, and I think we brought it up in a previous episode, and I would always caution that it also depends a little bit about what your longer term plans are, because there's nothing wrong, in my opinion, if you want exposure to trend following, to find just a handful of trend followers or 2 or 3 trend followers and invest with them and keep doing what you do in your day job. So if your passion is trading and you want to make a career out of that, for sure. But we don't all have to be trend followers. We can also make use of those who are already there. That would be my other comment. Let's jump on to the next one from Paul, all the way from Canada. He starts out with a small criticism of the show because he says, I continue to really enjoy the show. Absolutely excellent stuff. My only criticism is that I wish the episodes were even more frequent than weekly. So that's a very nice criticism to receive. Thank you for that, Paul. And then he says, 2 related questions. Managed futures is inherently volatile, not a bad thing. But my sense is that this makes it hard for investors to stick with the strategy for the long term. How are you able to help investors in determining what level of volatility / allocation is right for them in the long term, knowing that they might overestimate their ability to stomach vol in the short term? The other question is, have you personal volatility preferences? Has your personal volatility preferences changed over time? Let me kick off this one, Paul, because maybe we have a little bit of a unique thing going on our side. Maybe not. I don't know. But actually, what happens if you come to us as a new investor? I'm not talking about institutionals, but I'm talking about people who, individual investors who want to invest with Don. Actually, they all have to have a call with either our owner, Marty Bergen, or our CEO, James Daly. And in that, we call it a qualification call because we want to tell people that they should expect to lose money. They should expect certain drawdowns, and so that there is no surprise when they occur, because they will occur. I think that's important actually too, because you don't as a firm, you don't really want investors who are not a good fit for you either. That's something that I think has been practiced at our shop for all the time that we've been in business, so to speak. So then maybe that's one way of determining what the true level for an investor is in terms of how much they can stomach. In terms of personal preference, I'm not so sure that my personal preference has changed over time. I'm very comfortable with the strategy. I've been invested in it for, almost 30 years, one way or another. So I don't think my personal preference has changed. But I will say one thing, and maybe I would love to hear what you think, and Moritz. I don't think going through drawdowns are becoming particularly easier with time. Funnily enough, they feel as painful as I remember them, 20 years ago. Anyways, those are my thoughts.
Yeah, hashtag hate the drawdown. That's for sure. That's never nice. But I actually like the way you do it at Dunn with those qualification calls. I think it is important to be very explicit and open and honest and transparent with investors about the periods where trend following won't work, and there are so many. And as we know, investors tend to come and invest at highs when everything's looking great. And, when you do that, you kind of like forget about the bad periods that may have happened in the past, in the prior month, because you were coming out of a drawdown. But it's important to, to give investors that picture of, we're going to be in drawdown most of the time. Most of the time, that thing is going to fail. You'll have long periods of feeling unhappy about it. And at the end of that, long-term game, we hope to come out ahead. And thus far, we've managed to do that. But the path from A to B is not going to be an easy one. So they really have to understand that. I think it's great what you do there. And then when you started the question, I was thinking about the sarcastic quote or blog that Cliff Asness wrote this week. Did you see that on the fees and the
No,
the infrequent...
I missed that.
Okay, that's really great. So Cliff, being a funny guy, wrote a blog this week speaking about smooth returns, and that he's going to do a SMOOTH fund.
I did
and
see
he's
it.
going to charge more money for that, a higher performance fee, much higher management fee. And investors will just absolutely love it because it's going to be so smooth. He's going to publish NAVs once a year, something like that, right? There you go. So all the liquidity, all the transparency, just, out of the window. Nobody needs that. Let's just become illiquid and black boxy and, charge higher fees and have happier clients. I'm sure he meant that in a very sarcastic way, but that's also one of the ways, it's easier to stick with it is if you don't look at the thing every day. Of course I do, we do, because we trade that system. But if you're an investor and you really are in for that for, multiple years, and you've had that qualification call and you go like, yes, I will, stick to that for years and years, then really, there's no need to be following P&L on a daily basis. There's no need to follow it on a monthly basis. Just let it run.
Yeah. And I think that going beyond the pain of the drawdown, it's just going to be so great when you find somebody who loves trend following as much as you do. That's sort of what Dimensional Fund Advisors does. They make sure that these people drink the Kool-Aid, and you can't even be an investor unless you believe in this buy and hold and passive small, medium stock approach. And I think, okay, you're not going to have as big a business, you're not going to have as much assets under management, but the time and energy and heartache that you get by a misalignment of people, and then they act like, well, I don't really understand it. You need to educate me more. It's totally BS. There's nothing better or simpler, it's easier to understand the basics of than what we do. And
that's true.
Yeah, and I think that we just have to not be worried that we don't have a business that's going to raise billions and billions of dollars. We're putting other things first.
Have your personal tolerance for volatility, I think it was, Paul asked, changed, Jerry, over time?
I think so, only to the degree that the high volatility that I used to, more volatility, 1.5 to 2 times more than I had when I first started, it just creates anxiety for everyone.
Right.
But no one is in more control of the volatility than the CTAs. So if his perception or his investments are with CTAs that, as he said, sort of obviously have more volatility, then that's their fault or his fault. But who is in more control than we are? It's really difficult for a stock manager to say, I have a big stock fund and I only have 2/3 invested. No, they have to invest all the money in these stocks. And so they're at the mercy of the volatility of the stock market. Whereas we have lots more diversification. We just don't have, as we've said before, we just don't have CTAs out there saying, I'm targeting 8.5%. No, we don't have that. And then most of the time, our expected return based upon our leverage is much higher than that. And then most of the time, though, our volatility is really normal and nice. And then all of a sudden, everything gets correlated and we have more of a volatility than a stock portfolio, which from the get-go, that's going to be highly correlated. But we're very much in control. In fact, we even have vol targeting CTAs who every day or week or whatever go in and adjust that vol to a target. So there is no reason to, not saying it's not true, I'm just saying there's no reason for it to be true that you should be able to find CTAs, managed futures, who target 8% or 10% and even vol target, and wow, there you go. And currencies, commodities, stocks and bonds, longs and shorts, now it's going to be way less volatile than, or the drawdown, the 8 divided by 50, about an 8% return and over a 50% drawdown, that's just not going to be that possible for a CTA, maybe 8 and 20 or 8 and 25,
That's true. Very true. Well, I think we're going to get into more of this stuff because the next set of questions come from Antonio. And Antonio starts out with some very kind comments. So we appreciate that, Antonio. Thanks very much. Question number 1. How do you know that your current vol target doesn't risk ruin, but is still worthwhile if historical worst drawdowns are irrelevant? All right. Anyone wants to tackle that one first?
Definitely the historical worst drawdowns might be low. So pay attention to them. Of course, they are a data point, but don't think that it can't get worse. But I think the answer is you don't really know, regardless. Certainly, if your average P&L per day is plus or minus 5%, you're in some dangerous territory, let's say. But even if your average P&L per day is 50 basis points plus or minus, maybe. But I think the best rule here is that, even that you're really expert at backtest and you're a really great math person, so you think you have your risk of ruin down, just continue to exercise the ultimate in risk management and risk control, which is that at certain points, down 10, down 15, down 20, whatever you decide to make position reductions. So the old turtle rule was if you're down 10, you cut everything back by 20%. So it was a different era, a different vol target. We were making 200% a year and with really short-term systems. But that mentality of, if I'm down 5, I'm going to reduce risk faster. And as I start making money, I'm going to put the risk back on slower. So that, I think, is don't rely upon your risk of ruin calculations only.
When you say that, Jerry, you mean you're trading a fixed notional account size, and then if you have a drawdown, say you're trading a 10 million notional account, then you would reduce the size of that account.
Right. I mean, it's, if I had on 50 contracts of soybeans, I might get out of a third of them or 20% of them, and so or reduce the trade level. Yeah, so it's all going to come out to be the same. But once again, I think have this rule: you're losing money. I need to be on the defensive. I need to preserve capital. It may be a 5% drawdown for you and me. It may be 25 for someone else, and those type of clients. But never think that you've got this great system. You've done this great back test. The world's going to look the same as it has in the past, and I have nothing to worry about. And I think that's where disaster can come in. You have a positive game. You'll eventually win. Just stay in the game and trade small and use risk management. And, you're going to come out of the hole slower. And every time I've ever cut back, it's my position size and my trading during a drawdown, it never works. The computer says, don't do it. It doesn't work. And it's always been at the lows. And I think that you should have an approach and a leverage to where it's very infrequent. You don't want to do this once a week or once a month. You want to do it every 2 or 3 years, possibly, when the markets get really poor or really choppy and performance is low. It's much better to trade smaller than to have to do this frequently.
Yeah, and I would just add to that it's true that we often say that our worst drawdown could be in front of us, or probably is in front of us, but I don't think, Antonio, I would go as far as saying that historical worst drawdowns are irrelevant. I don't think they are. I think they do tell you something about your system and so on and so forth, and the risk levels you're running. But it's a good question, and I think it's a great answer that you got from Jerry on that. I'm going to go on to the next question because there's quite a few of them. So maybe you want to tackle this one, Moritz. We'll see. If asked about your future trend following strategy performance expectations, how would you derive annualized expected rates of return over the next 5, 10, 40, 100 years?
Right. So there's this is a question I've been asked quite a few times is what do you expect to make going forward? How much money do you think is in this? How much money do you think we can make next year? And what is going to be the annualized rate of return for the next 5 years? Things like this. And, none of us can sit there and say, well, I think it's going to be 8 or 12 or anything like that. I mean, the answer is, I don't know. That is the only fair answer that we can give. But there is a but, right? And I always, I came to the point where I say, well, looking at the way I've traded that, looking at the live track record, looking at the back test, looking at all the data that I have, and looking at the way the system performs right now, the system has performed in the past, I have no reason to believe that any major item of that system is broken. I have no statistical backing to assume that trend following markets in the way I do it is no longer going to work in the future. I may have to evolve certain things, but there's absolutely nothing telling me right now that it stopped working, and it stopped working for good. So as a result of that, I tell people that I expect my system to perform on average just in the way it did in the past, with all the volatility around it, but just with, the historical rates of return.
I think the other thing to add to that is that the only thing we really control, and Jared talked about that earlier today, it's not the return side. What we can control is the risk. And I think not many CTAs that I come across at least talk much about, expected returns, et cetera, because as Moritz just said, we know we don't really know. But we do know how we manage our risks and or the risk of the portfolio. And so I think that's really where most of our focus goes. And also, I mean, again, time frame is so important when it comes to determining what's the performance of one investor versus another. I mean, imagine you have two investors and they start, at the same time, and one stays for 10 years and the other one stays for 11 years. But at the point of the year 11 turns out to be a down 30% return or year. Clearly, they're going to have very different overall return because of that event. I would just say that I think Moritz is right. I mean, we don't really talk much about, and we don't know what our future returns are going to look like. But of course, we look at our historical track records, and that's the only thing we can document. Yeah.
Yes, and I think the only way we can look at that is by looking at the numbers and the data and the stats. And we're being asked about the the drawdowns. Is your worst drawdown ahead of you? And we would say, well, given enough time on that lovely planet Earth and enough time to trade the system, the worst drawdown is probably ahead of us because we'll consume more data, we'll do many more trades than we've done in the past, and then many more than are included in the backtest even. So statistically, the likelihood is that the worst drawdown is ahead of us. The same can be said for the a period of, say, flat performance. 3, 4, 5 years of bad trend following performance, which people think that we've had. I mean, yeah, sure, great, but that there could be 10 in the data set in 50 years from now. It goes for all the stats of the trading system, not just the worst drawdown. And it, in the same way, it does go for the returns. So I think, I always, want to look at that from that side of things, and also, speak to people that ask me that question, answer that question in that way.
And let me just add two things more, actually, thinking about it when I hear you speak. One, all of this can be said about any strategy in the world. I mean, how do you come up with any, real expected return in the future? I don't think you can. And if anybody told you that, oh yeah, I'm sure I'm going to be, delivering 10% return in the next 10 years, I probably wouldn't pay much attention to that.
Yeah. We can only make what the markets give to us, but we can't control our risk.
Absolutely. Do you have anything you want to add to this one, Jared? Do you want to tackle the next one? There are plenty to come.
Next one.
Okay. If you don't, and this is also Antonio, if you don't have an expected annualized rate of return, why bet at all that the unexpected moves or major trends will pay for the whipsaw, overinflation, and transaction costs?
Well, I don't think those two go together. I can answer the second part, but why would that go together? That if I can't predict what I'm going to make in the future, then why play for home runs and strikeouts? I mean, does that go together? I mean, correct me when I'm finished, but I think it's safer. That's all. That's all. That's the only reason. We're using a systematic price only approach. And we're taking small losses, massive diversification, longs and shorts. And the computer says, all right, you're right. You'll make money. You do have a safe capital preservation way going here. But the problem is you got to make all of your money on very large trades. Oh, no, larger than that, even larger. Yeah. Oh, what a bummer. So that's what the computer says. That's what we've all done. We've all profited from it. Everything we have, well, at least for me, is due to that, the homes, the cars, everything. So that's why we do it. The computer says it works, and we've experienced it.
And I would add to that and say, well, just because we don't, verbally say that, oh yeah, we expect our strategy to deliver this kind of return going forward, it doesn't change the historical data and what it has done for us, and the fact that it has delivered better returns than inflation and transaction costs, et cetera, et cetera. So I just think it's just because we are maybe prudent about the fact that we don't want to be, making forecasts that we have actually no real, that we're not able to predict with any certainty. But it doesn't change and you can go one step further down, Antonio, and you can just think about the concept. Why do you want to do trend following in the first place? Well, we do it mainly, I think, because we believe that, markets moving up will attract buyers and moving down will attract sellers. And these behavioral tendencies or biases that we all have as human beings, we generally don't believe that they will change. And as long as they don't change, there will be major trends from time to time. And what we've seen in the past, Jerry's got, 30 plus years and done 40 plus years of real evidence of that paying far more than inflation and transaction costs. So why wouldn't we believe it?
And maybe, I don't know, maybe he was saying that you're not willing to be bold and forecast, then maybe you don't really believe. I don't know. I'm trying to usually try to figure out. I spend way more time figuring out what his questions actually mean versus my answer. I get my answer in like 30 seconds. After 35 years, it doesn't take me a long time for an answer. It may not be right. He's definitely not going to agree with it, but I do it because it's safe. It's safe. And as I've said many times before, what part of what we do are you willing to give up to make more money? Large losses? No. Lack of diversification? No. Discretionary, not systematic? No. I'm not willing to give up any of those things. Losing money, a little bit of money over a long period of time, churning away, making a little bit, losing a little bit, that's the worst that it's going to be. And I still have an opportunity to maybe have a good year every now and then. That's a good bet for me. I'm just too risk averse to eliminate parts of what trend following offers.
There is one more question from Antonio in this email, so I will take that, and we'll see if we can answer that. If you believe in equal probability or expected analyzed returns is unchanged regardless of a drawdown or a run-up in trend-following equity curve, wouldn't it suggest new equity curve highs are extremely difficult to achieve after a major drawdown? For example, if trend following has annualized returns of 8% and trend following falls 45%, why would I expect trend following to continue to have an 8% annualized return from the trough as opposed to a higher annualized return? Conversely, after a run-up in 2008 or 15, why should I expect 8% annualized returns and not less than average? Well, clearly returns can change from your entry point. I think that's very natural to expect that if you buy the drawdown, which luckily a lot of investors do, they probably do get a higher return than the long-term average if they do it right, and vice versa. If some people trim their exposure after a big run-up and put it back after a correction, I think you can get a higher return than your long-term average. I'm not sure whether that is exactly your question, but clearly the long-term average or annualized returns that trend followers deliver includes the ups and the downs. But if you time it and you're lucky, not that I would never suggest anyone to try and time trend following. I think it's incredibly difficult. But if you do and you get it right, you should expect a higher annualized average return, but vice versa. If you get it wrong, it will be lower.
It sounds like a math question, and which I'll usually defer to people on my staff who are math experts. But I know the answer. I think I know what the answer is, but I don't. But I would explain it in more of a layman's terms, in that at the bottom of the 2008 stock market, what were the chances that the market would have the rally that it's had since through 2018? Like zero. Yeah, everyone said no. There's just no way. This would have been the question. How can we expect? Well, you know what? It all happened. And I have had, in the midst of drawdowns, I've had people call me up and send me emails and say, you'll never make money again. Even after 5, 10, 15, 20 years of new equity highs all the time. This is the comment. How are you going to, 8%? My gosh, 90% of the time, I would be thankful for an 8% drawdown or whatever. I think that's what he said. But wow. When you play a positive game and you're eventually going to win over time because you have an edge, you can't discount the power of that.
No. And of course, the same argument goes for equity investments, right? If you bought the 2008 or 2009 low in equities, your returns for the past 10 years would be higher than the average. I mean, it makes sense. So
this question is usually something along the lines of some sort of trick math question. Like if you flip a coin and you get 10 tails in a row, is heads ever going to be able to catch up to 50-50? I know the answer is yes. So I think that's kind of what he's saying. You'll never catch up. Yeah, we will catch up.
Yeah. Good stuff. Thanks very much for the questions, Antonio. Let's move on here. Brian sends in a question. This is more of a business question. Maybe Jerry will comment. He says, how does the CTA choose a company to sell their investment, such as a mutual fund? Are there only select mutual fund firms who will consider doing it? Both Don and Chesapeake do this. Curious for any similarities or differences.
Yeah, that's outside the scope of, not sure how to answer that one. That's find a mutual fund partner that likes your performance. But other than that, yeah.
Yeah, no, I think the true answer here, Brian, is that there are actually not that many mutual fund companies that run platforms where you can put in a CTA strategy per se, and then successfully market it through their network, et cetera, et cetera. So it probably comes down to a handful of firms that you can go to, and obviously Jerry chose one, we chose another one. And the same goes for, you have another question about how you implement it. Some people use swaps, et cetera, et cetera. This is a little bit technical, but in our case, it has to do with the fact that we don't charge a management fee. So in order to get a performance fee, One of the ways you can do that is using a swap structure inside your mutual fund that is allowed. Other people do it differently. So I don't think it makes a big difference which way you choose to do. I do think it makes a difference in terms of what company you partner with. If you're looking for a partner to sell your mutual fund, there's a big difference between their capabilities in terms of raising assets and so on and so forth. But no, I mean, I think that's probably as much as we can help you with on that one. There's a question from Samuel. You have all discussed correlation in the past, but what level of diversification based on correlation is enough on your minds? Certainly, if you have 3 or 30 assets that have a simple aggregated and average correlation between all of them of 0.0 or 0.8, this isn't great. Ideally, I think the end goal is to have this number to be 0 or as close to that as possible. But what do you think the norm is or the minimum needed to have some level of comfort with your portfolio? Then he goes on to say, secondly, Jerry has mentioned in the past he does not adjust his position size based on ongoing volatility during the trade, and that he's willing to accept much more volatility during the trade as a bracket as a winner. He has also said that he will trade smaller in a drawdown, meaning if the standard risk is 50 basis points, he would advocate maybe risking 40 basis points once you enter a drawdown of some size. Does this mean only 2 things will really cause him to adjust the total position / risk of a trade, a drawdown, or a change in account equity value?
That is true. Losses, and like I said earlier, reducing your positions and your new positions that are coming up when you're losing money is a good idea. I do think that extreme vol targeting is makes you take smaller profits, and so you have to trade a little bit larger, so your average loss will be a little bit higher. I do think that if a market, I was in a dollar index trade a few years ago, and the volatility was 10 times as high at the end of the trade than it was when I put it on. So I think if you have this position like natural gas or some of these positions get crazy, volatile, parabolic. If you want to scale those things back after you've made tons of money, I don't think that's a problem necessarily. It's just scaling things back because you're getting a little nervous. It's not like great mathematical genius. So yeah, I think that's, you kind of want to allow the trend following to do its thing and be bold with your winners and cowardly with your losses.
Yeah. Just to answer your first question also, Samuel, I think in terms of correlation and finding markets that make sense, I think sometimes also just a common sense approach would be a good idea, and clearly just combining different sectors with each other. And maybe not being too focused on what's the correlation, because the correlation will change anyways. And as Jerry mentioned earlier, there's been examples in the past where suddenly one market within the same sector, just takes off. I mean, we saw it last year with nat gas, for example, and we see it on a regular basis, I would say. So don't be too hung up on that, but clearly, you need more than 3 assets to get diversification in your portfolio. I would say once you get past 25 or so across different sectors, you're starting to get into a reasonable zone. Often I've seen that managers who get to sort of 50, 60 different markets across all sectors, the added diversification benefit from adding markets will obviously decrease somewhat once you get past that point. But I'm not here including some of the newer markets. I mean, there are newer markets that have come along where you could probably get some further diversification. And then finally, you have one last question, and then I'd love to hear Moritz's thoughts on this. Actually, you talk about how often should one adjust positions based on account equity, and you quote that you think that we do it on a daily basis at Don, and that is correct. I mean, we do take into account what is the total AUM we trade on a daily basis, and it doesn't mean we change position on a daily basis. We have some thresholds that that we need to hit before. Otherwise, you make too many small trades. But some people do it monthly. Some people do it daily. I don't think there's a right or wrong. And I don't think, frankly, that it makes a big difference in performance-wise.
Great question. I think on the position sizing, as far as I'm concerned, open positions, they tend to stay unchanged until, they exit. My new positions, they will react to a change in the account size or the net liquidation value of the account. So if I'm in a drawdown, if I'm losing money, then my next position is going to be smaller, assume same volatility, same ATR, than the previous position that was taken on at a higher account value. So that happens automatically. And I'm fine with that. And then, the diversification question, I must say, I can't get enough of it. And sure, you can mathematically show that after the 15th or 20th asset, the diversification benefit starts to decrease. And I agree with you, Niels, that, we can apply a common sense approach to things. Of course, this is true if you're adding, say you have 50 markets and you're adding another equity index to a list of already, say, 25 equity indices, then, potentially the added value, the added diversification benefit of that market is going to be relatively small. Maybe it's still worthwhile doing it, depends on the market in question. But if you can find, tradable instruments, which are, very independent from the rest of your portfolio, some of the newer markets, it may be glass or eggs or, power in France, power in, Spain. Those are markets, by the way, power in Spain is a tradable market. I find that to be very uncorrelated to other things I have in the portfolio, uncorrelated to the energy spectrum. So that market is very valuable for me to have as part of my portfolio. And I don't care if it's the 80th market or the 90th market. I still want to have that in, because the more markets I trade, the greater, I'm spreading my bets across a larger set of markets, and the greater the probability that, just one of those markets that I happen to be trading and I'm taking all the trades, one of those markets will become the runaway winner for the year. So I like thinking in that way, and not kind of like, closing down the portfolio at a certain level of markets, saying that, well, it's diversified enough, I don't need more. I always want more. Can't get enough of the diversification, I must say. So yeah, that's my view on that. And that's where, I think I also, when I look at what I do, a lot of the, research goes into that as well. Maybe also not just in adding markets, but, the way you trade markets, trade spreads, for instance, does that do something to your portfolio? You may be doing that with, markets you already have in your portfolio, but, create synthetic time series that all of a sudden start to do something different in your portfolio. So it's an interesting topic.
Absolutely.
Yeah, I think most of the people who are trading 100 markets, they're trading cotton, sugar, cocoa, coffee, nat gas, emissions, cattle, hogs with one unit, and then crude, heating oil, and gas are 1/3 of a unit or something like that. They're not trading, all of these 100 with equal risk. They're recognizing, Jerry said heating oil doubled twice and crude sat there. So do I want to choose crude or heating oil? Hey, why don't I just trade a little bit of each? I'm not going to trade it as large as cotton, which is not correlated with anything. So I think that makes sense. There's no cost. There's absolutely zero cost. I mean, you got to put in an extra order, but I'm obsessed with diversification. No one is more obsessed than me. Start trading your single stock futures, start thinking about synthetic markets, then come talk to me. Shorts, oh my gosh. We add so much by trading shorts. All of these markets are positively correlated. So 10 longs is more risk than 5 longs and 5 shorts. Every market, any market. So another thing that's very important. And I like to keep my trade level the same throughout the year. I want to be placing these bets every day, the same bet on January 1st, risking the same amount all the way through December 31st. So, and I'm going to include the profits at a slow rate, reduce the trade level based on losses much quicker. So there's a randomness of changing the trade level frequently or in big chunks that can overwhelm the positive expectation of the trades themselves. So I want to not allow that randomness to be too material. And I really want to sit at that blackjack table every day of the year, risking $1,000 or $5,000 or whatever it is for every hand. So my edge is what's predominantly going to determine my performance.
Great answers. Let's jump to a question from Brian, and then I want to close with a question from Seth, and then I want to talk about the article on Bloomberg before we wind down for this week. Brian says some very nice comments in the beginning, and then he goes on. Most recently, Sol Waxman observed, and it was reinforced by Meb Faber, that investors have a double standard for returns on futures returns compared to equities. As three of the best and brightest trend followers in the industry, in your experience, why is this the case? Moritz, any thoughts on your side?
I'll let Jerry start on that one.
Thanks. That's a tough one. I mean, I think in different ways we've brought this up. But let's try not to blame it on others. Like I was saying earlier, maybe volatility is higher. We're charging higher fees. Stocks are, you just sit back, relax, and the S&P is the best performer. You're not paying anything. You understand it better. You think you do. You like it more because it's more familiar. All your friends own it, and so market's down 5. We're all down 5. Probably not 100% the client's fault, I would say, obviously, even though I have a tendency to sound that like it is.
I mean, I think the double standard, comes from a couple of different sides. I think whether it was Meb who talked about it, I'm not entirely sure. But I think the fact that futures inherently involves some level of leverage compared to what you put down as margin and the contract size you trade, it has always had kind of a bad rap with many types of investors, especially if you don't really know much about it. So it sounds more risky. And of course, in 10, maybe more than that, 15, 20 years ago, the word derivatives and futures were really not very popular in the media. I think that has changed. I think more people now understand that the value of what futures, the role that we play when we trade futures, the liquidity it provides, and all of that. But I think it is a problem. I think it's this home bias we often have. I think the more people know about equity, so they feel more at home about that, and therefore it is a double standard when it comes to futures. It's meant to, as that we should be doing much better. And I think, as Jerry often alludes to, we are doing better, no doubt about it. We're not an 8% strategy with a 50% drawdown. So we just have to continue to educate people about these things. But you're absolutely right, Brian, that it is a bit difficult to understand why people treat it differently. But I think the financial media, not to blame anyone, as Jerry started saying, not that I really want to blame anyone, but I think the media plays a very important role in pushing equities as one, and bonds for that matter, as asset classes that are, everyone should own, and things that are a little bit different with much more skepticism, if I can put it that way. Any thoughts, Moritz? Or do you want to take the next one?
Take the next one.
All right. It's something we've actually talked a little bit about earlier today. So, but anyway, Seth has a couple of questions. I'll take question number 1 today, Seth, and I'll do the other one next week. He says, you guys have mentioned on several occasions when talking about diversification that there are something like 15 unique market groups or sub-asset classes. I would be interested to hear you guys go over them and show on the show sometime. Sorry about that. Thanks for a great show. So, do you want to quickly sort of talk a little bit about some of the sectors as such as we see them in our industry?
Yeah, sure. Let's start with equities. Jerry's trading the single stocks. Niels, you and I were looking at the equity indices. That is one bucket. I've seen trend following systems that also include equity sectors. Like there's the financial sector, there's the building and materials sector. There's products that you can trade there. So this is the equity complex, if you will. Then, as far as currencies go, you have the major pairs against the dollar. You have the crosses around the world. The crosses may be a bit more difficult to trade. There's some available that you can trade, but some other ones, say the Colombian peso against the Hungarian forint, you're not going to be finding a futures contract on that. So you would have to trade that spot or OTC. But that's currencies. The fixed income and interest rate area is government bonds, government bond futures of different durations or maturities. So you have, very short-term bonds, 1 to 2 year, 5 year, 10 year, 30-year bonds. You have short-term interest rates like Euribor, LIBOR, the Eurodollar, all of that. And then the commodities, this is where you can't really say it's commodities because, the commodities are, you have agricultural products, the livestock products, you have energies, you have base metals, you have precious metals, you have power, you have materials, there's, emissions, all sorts of very great diversifying markets that I recommend people have a look at and include in their portfolios. The grains, the softs. I mean, this is a big and very important area to add in a trend following portfolio. So when you sum it all up, it's not that difficult, really not difficult to find more than 50 markets to include in a trend following system. And, as we've heard before, if you want to, include the crosses and OTCs and become really detailed, then you can, do it with 200 markets.
Yeah, absolutely. And I think I sent you an email, by the way, Seth, just to reply more specifically about this as well. So hopefully you got the answer you're looking for. Thanks to everyone, by the way, for the questions. And as I said, do keep them coming. Just send them to info@toptradersunplugged.com. And then we will get to them. I'm sorry that there's a few ones we're skipping today, and we'll get to them next week. Now, the reason why we're doing that is because we want to maybe just add a little bit of our thoughts to this article on Bloomberg that came out a couple of days ago. One of Wall Street's most popular trading strategies is now failing. And I'm sure you guessed it. It is trend following that Nishant Kumar has written about on March 1st. 6 o'clock CET, it was released. I think we all skimmed it. I think maybe you, Jerry, tweeted a few things from it. But of course, it's a popular headline. We've seen it before in different shades. Trend following is dead. Now it's failing. What were your thoughts about Mr. Kumar's article?
I have a list. So I'm very prepared on this one.
Nice.
My first thing on my list, I sort of went in order. Quote, turns out the algorithms behind so-called trend following quants are rather primitive and suffer from many of the same weaknesses a mortal brain might. I like that. And honestly, I think, as I've said many times, I like the word primitive. We had a list before we went on the air today of all the different explosive words that people have used recently. I didn't remember deplorable, but maybe that's next. But I think primitive is good. Primitive systems are what's needed to have a large sample size. We don't want them to be too primitive, but entry, exit, stop loss. We need our sample size, historical back test to be large. So I'll give us an A+ on defaulting towards primitive. That's a better word than simple. I'm going to start using that. I like it.
Sure. And of course, in the same paragraph, he goes on to say, they've struggled to react fast enough to the unforeseen side effects of ending a decade of central bank stimulus, and even seem to get baffled by US President Donald Trump. And I'm just thinking, when I read something like that, I think, unforeseen side effects. I mean, some of these strategies, and certainly the firm that I work for, we've done this for almost 50 years. And I can assure you, Mr. Kumar, that there has been many unforeseen things that these models have had to cope with. And I really don't think that what's happening today is something that they won't be able to cope with going forward. But they will do it in the same fashion they've always done, and that is not to create performance in a straight line, that I know, of course, a lot of investors would like us to do. But it is simply utopia to think that that's how you can survive in markets for a very long period of time. You can optimize your strategies to make them look safe. In reality, they'll probably come out short in a very bad way at some point. And that is why I don't think there's anything wrong with struggling from time to time to react fast enough, because in the long-term trend following seems to be doing just fine when you expand the time frame a bit. What's next on your list, Jerry?
CTAs haven't performed due to Trump's tweets. I thought that was kind of funny. I also added my tweet, how about global warming? So, tweeting, and I thought that was just kind of funny that's what he says. But to expand upon your point, I think the CTAs have done very well in surprises. Crude going from 90 to 20, very big surprise. Who stayed long interest rates when they started approaching ridiculously low levels? CTAs. Why? The trend was up. We're well built for surprises. Who made money on Brexit? We made a fortune on Brexit. Who made money when the stocks were rallying and everyone was saying overvalued and value for many, many years. And of course, this is what the strategy is built on, nothing more than the trend, and people obviously not agreeing with the trend and being very surprised. So I don't really understand the surprise point of view. Crashes, this has been a problem.
And it's a problem for most strategies, right? I mean, a crash is something that is, the only people who get it right are people who, either know something others don't know, or just are lucky and get the timing right.
And if you can be well positioned before a surprise, then is it a surprise? So everything is a surprise. Every market move that happens or doesn't happen, everybody is going to be somewhat surprised. I really don't understand. There hasn't been big uptrends. That is a very short article. You can't use primitive, and archaic is another word. These are great, fun, explosive words. He's a writer. He's very talented. I like that. And but it's, call me and let's have a discussion. Not going to be a good article. It's not going to be as fun. It's not going to be the number one trending article on Bloomberg, like this one was.
And the other thing he seems to have a problem with is, but trend followers keep it simple, identifying when to enter and exit trades by backtesting price trends against decades of data. Not sure what's wrong with that, actually. Any more points on your list that you want to raise?
Yeah, I didn't understand how Winton going from 50% to 30%, according to him. I think most people remember Winton saying it was 25%, but how that is proof of it being archaic. Those guys are way too smart to put in even 30% trash into their portfolio. They would go to 0 or maybe 5 or 10 just for diversification reasons. But don't think that was a very good point. Oh, one of my favorite is, I loved this. Even the discretionary managers were having trouble, even discretionary.
Right.
A systematic approach cleans the clock of discretion. There's not that many discretionary left. The discretionary managers over the past 4 or 5 years have tried to become less discretionary. It's been major headlines. I just think that's kind of funny that a systematic approach gets negatively compared to people who are winging it.
Yeah, that's true. What about you, Moritz? You're very quiet.
Well, quiet because I think just like you guys, there's not that much to add. I found it funny when he said even got baffled by, what was it, Trump's tweets. I mean, who doesn't? I mean,
Sure.
There's not a single strategy out there that isn't surprised by the president's tweets. Just nothing you can do about it. I mean, I skimmed through it. It's one of those things that we've seen again and again. It's fun to read them and how they want to spin a story out of that. I'm sure trend following is dead. It's over. We should stop doing it.
I also like the comment he has where he says, it was the crash of early February 2018 that really exposed the limitations of CTAs. It happened unexpectedly after a rally in January, only for markets to bounce back days later. Unlike high-frequency traders that can get in and out of trades in milliseconds, CTAs are typically programmed to change holding slowly over several days or even months.
Look, I mean, I get it. I mean, they need to write, they need to, create clicks and probably count the number of downloads at the end of the day and, compete for ad dollars and all of that. I mean, that's just, it's an industry, it's a machine. Saying something like this is, I can only, accept it when I, view it through that light, that they're doing a job. They want to make money writing it that way. Of course, I mean, at the end of January 2018, I mean, guess what? All of the CTAs were long equities. There was no reason to be not long equities. We were super long equities because they were trending and they were going up. So, sure. I mean, then there is that reversal in February. I mean, what do you expect? Yeah, we're losing money on that long position. Imagine that reversal hadn't come. We would have had another 6, 7, 8 months of uptrending equity markets. We would have been the superstars. But what can I say?
I had another tweet this week where I, for some reason, just blurted out this idea that given such a poor return risk profile, that really long equities, I don't think it deserves a place in a portfolio. And not a material amount anyways, not from a scientific evidence-based point of view. Who can hold on to these things? That's never kind of part of the performance evaluation, is that, the 5% of the people who are going to hold on down, 55 with most of the money in passive equities in 2008, there's just not that many who can do it. So theoretically, an 8% return with unlimited drawdown, we say 50 something. If you go back far enough, it's 90%. The problem with not having it is it does work. It does work sometime. So it's not a good bet. It's not something that most people can handle. And yet when trend following really fails, not just the stock market, many trades where natural gas, we've sold the low, and now the current front month is almost back to the highs of that front month. So taking unlimited risk, that will work sometimes. And that's essentially what they're saying. So I just don't think we should be shy about saying that it's not something we're willing to do. It's too risky.
Absolutely. And I think, as we all agree, these articles, they will pop up from time to time, but it would be nice, I think, if some of the people who write them would actually, try and understand the strategy before they write, because to me, at least, it doesn't seem that evident that in this case at least.
And regardless of what the reality was at the end of 2008 or beginning of 2009, there'll be a lot of people who would stand up today and say, I still believed in buy and hold. And this is what it takes to get that equity premium. Okay, we're saying the same thing.
Yeah.
Except with a much better return drawdown profile.
Absolutely. Anyway, I'm sure there might be a few more tweets coming in the coming week about this topic or an article perhaps. So we'll see what comes of it. Then maybe Mr. Kumar even will be listening to our podcast. So anyways, I think that concludes our comments, our questions today. Let me just quickly run through where we stand. Now, these performance numbers are actually as of Thursday evening, as they always are. And of course, Thursday was the end of February. So they're actually February numbers or estimates. So the Beta 50 index ended up plus 50 basis points, down 1.27 for the year. SocGen CT index plus 44 basis points, down 1.45 for the year. SocGen Trend Index up 0.9%, down 2.34% for the year. The SocGen Short-Term Traders Index was down 1.18, down 2.80 for the year. And the Bridge Alternatives, the Flat Fee Index, down 0.14 for the month and down 4.18 for the year. Anything you want to add today before we wrap up? It's been a long one today, but lots of good questions, so we appreciate that.
Happy trading, everyone.
Yes, happy trading.
I thought you had a new slogan, Jerry.
Yeah, it's something.
You forgot it already?
I got to write it down. It's follow the systems.
Follow the system, exactly.
Absolutely.
It's sexier.
Let the rules be the guardian angel. On that note, we're going to wrap up this week's conversation. We hope you've enjoyed it. Keep your questions coming by sending them to info@toptradersunplugged.com. Send us a tweet. And of course, make sure you subscribe to the Top Traders Unplugged podcast to be sure to get all the new episodes directly where you listen to podcasts. And if you felt you got some value from today's conversation, please do share it with your like-minded friends and followers. Of course, we're always grateful if you would leave us a rating and review. It really does help us and other investors to discover the Systematic Investor series. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.